Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media like we normally do. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive right in, take a look, see what's going on today. And if you want to follow me, it's at @Finance. And if you want to join our community, learn a little bit more about investing, head over to finding-value.com, sign up using special as the coupon code. It's a $25 charge for the first month using that special coupon code on the monthly membership. And it's $500 for an entire year using special as the coupon code to learn how to invest, at least from my perspective, in my opinion, in my viewpoint, strategies. We recently went over some questions in the Q&A session. Talked a little bit about portfolio allocation, a little bit about position sizing, companies that I overweight versus not give as much weightings to. And we cover different topics each weekend. They are recorded and they are uploaded to the website. And you can obviously watch all the previous ones if you feel inclined to. All right, so coming down, HFI Research. Welcome back to the casino. May the weather gods be ever in your favor. Natural gas trading profits are not guaranteed, but acid reflux is a certainty. So we're talking about natural gas storage. Natural gas storage capacity has not kept pace with the material increase in LNG gas export capacity. This mismatch will create extreme price volatility. In the scenario we laid out above is just a teaser for what's to come in the years ahead. What are they talking about? Well, demand for natural gas has grown substantially. The gas tank, so to speak, the storage capacity has not. So it's kind of like you've got production that produces natural gas, and then you've got a storage tank as a buffer against demand volatility. That buffer has declined dramatically in relationship to production. So your days of coverage have declined substantially. So it's kind of like running a gigantic engine. You're producing some of the gasoline, but when you surge or when you floor the big engine, you have a little tank to cover the surges in demand. And right now we're running this teeny little tank on a big engine, and we could easily run through that storage capacity quite easily. So that leads to volatility in prices. And the smaller the days of coverage, the worse the volatility. Because what you're trying to do is you're trying to not overfill that storage capacity, and you don't want to have it run dry. So price needs to dramatically increase and decline based off this small storage capacity. it's not a good scenario. It's great for trading. If you're a trader, this would be one heck of a time to be trading. I think it's going to be fine with the demand going up, but for natural gas, for equities and stuff, but you're going to have to live with a lot of volatility. Here's a quote. It says, "The stock market is a device for transferring money from the impatient to the patient," says Warren Buffett. I take advantage of this. So part of my strategy is taking a longer time frame than everyone else. So then I can buy bottoms. And yes, impatient people will not want to hold and wait for that bottom and market condition to change for it to come up. But it allows me to sit and wait and get really cheap prices. That is the trick to all of this. Let me put something that maybe is a little bit more understandable to everyone that's listening. The way that you make money isn't by doing something slightly better than what everyone else is doing. Perhaps you want to adopt strategies that no one else wants to adopt, or very little people want to adopt. it almost goes against the natural tendencies that humans have. They use price as a gauge if they are right or wrong. A lot of the technical analysis people do that too. If you're patient and you buy value, that's not just your advantage. You can wait people out. It's like a secondary plan B. So plan A, you can use technicals. You can use undervaluation for a sector. You can do all of those things and they can all align. And let's say it doesn't go up immediately. You can use time as your second buffer, your plan B, because you can wait them out. You can wait them out and let the market condition come to you and have it turn and move on up. So you can be a multi-threat where you use technicals, and let's say a lot of the time, not every single time, but a lot of the time, you are right in I'll say a okay time frame, within 6 months. But every once in a while, let's say the market takes its time and it takes a year or two for something to develop. Well, if you purchase something that's undervalued, you purchased at what I'll say close to a bottom, so you don't have much downside, you can just wait it out. And if you don't put all your money in one sector, you spread it out, you become more resilient as an investor. Resiliency is something that I don't hear a lot about. A lot of people, what they try to do is they go, I'll just call it balls deep in one sector. And you know what happens to them? They get scared. They get fearful. They're impatient. Why? Because they've got everything riding on one sector. That's what you don't want to do. So rather than putting all your eggs in one basket, putting it all in one sector, all in one company, all in one ETF, whatever it is, what if you've got like 7 or 8 different ideas and they don't all occur at the same exact time? What that does is it smooths out the portfolio. It gives you resiliency. It gives you more patience because some of the sectors will go up. Some of the sectors may lag behind. But you say, you know what? I don't have all my money in it. That's okay. And then you just ride through it. And then when the other sectors become, we'll call it a little too hot and they want to consolidate or pull back, maybe the one that's been lagging behind starts to take off. Now all of a sudden you've got this kind of portfolio that's self-balancing itself. It's starting to balance the volatility. It kind of smooths out your emotions. It allows you to be more patient. So understanding how to set up a portfolio, position sizing, understanding the companies that you own, it kind of all comes together and it allows you to be more patient. I think the impatient comes from the gambler mindset. It comes from position sizes that are too big. And if you go all in on one sector, that would be too big of a position size in one area. So I think patience is a factor of a couple things that we just covered there. S&P 500 relative to gold, 1970s versus now, which is it's a good comparison because of the commodity to stock ratio matches. It says make or break. I think it's a break, especially when you have a CAPE ratio at 40. So he's got the 1970 breakout to the downside of gold outperforming the S&P 500. And I've shown that ratio chart. It's breaking out already. And then we've got today where he thinks that this is today, and then he thinks he's going to break to the downside. I agree with that. And I think the driver is interest rates and capital rotation event. Gold's already starting to outperform the S&P 500. We're already breaking out. So if we were to do XAU USD divided by SPX, we are already breaking out here. You can see it turtle heading out of this resistance area line. It looks fantastic for this to happen. And all of the setup before it, it has a great setup before it too, where this is going to follow through to the upside. So yeah, I agree with him. This looks good. Art Berman, a glut today, a shortage tomorrow. The oil markets fighting the wrong war. After a decade of underinvestment, Saudi Aramco warns the real crisis isn't oversupply. It's what happens when the taps run dry. Let me tell you how to make a lot of money. I'm sure you guys are interested in making money, right? So let's take that patient and impatient quote above. Let's apply that to this. Today, everyone is worried about this glut. Tomorrow, the insiders are worrying about when the taps run dry. And it's not about that sentiment or that opinion or that outlook. It's about the facts. So let's go over the facts. The oil to gold ratio is 7 standard deviations on the cheap side for oil in relationship to gold. We have a perceived glut today, and a lot of the insiders, OPEC and other insiders, whether that be the Permian Basin producers, they're saying, dude, a couple of years out, where are we going to go with Permian oil production? It looks like it's peaked out and we could decline. So where's future oil going to come from? Now, I don't know. Maybe some of these other guys, maybe they do know, maybe they don't know. But it's a big question mark. We've got the commodities that are cheap to financial assets. We've got gold breaking out against the S&P 500. Every time that gold is broken out against the S&P 500, we have had oil go up in a commodity bull market. Every time. And oil is 7 standard deviations to the cheap side, which means it is the cheapest it has ever been in the history of the market. So the way that you make money is you identify that type of anomaly in the market. You say, okay, we are really cheap in oil. There could be a potential problem a few years out. So what you do is you take a position and you maximize your patience versus the impatient. That is how you get rich. Another way to do it is you identify the opportunity like I just described there. The opportunity is 7 standard deviations cheap. The opportunity is oil, the perceived glut today versus the shortage of tomorrow. And then you go and you look at the companies. You deep dive into the companies. You understand the companies so you can be patient and hold them. That's how you make money. It's not running around reading charts and having no idea of what you're buying. You want to have the idea of exactly what you're buying. You want to be a shark. And you want to be a shark when everyone else is running around scared. And you want to be a shark with the knowledge of buying the cheapest sector in the market at the beginning stages of a commodity bull market. 7 standard deviations, cheap for oil against gold. That's how you make money. And then you're patient enough to wait and see it through. And the way that you see it through is having that knowledge of the companies, having the knowledge of the technicals, adding it all up and going for it. Now, it doesn't mean you put all your money in it. You should already have money in precious metals, and it's going up. But precious metals was the opportunity of yesterday. It's not the opportunity of today necessarily. Now, there are a few sectors, a few that are completely out of favor that I am buying right now. And if you want to know what those sectors are, obviously sign up to the website. But that's how you make money, guys. That's how you do it. You find the areas that people are either super negative on or that people aren't even talking about. that people aren't searching on YouTube for. Those are the sectors you need to get into. Very early in the week, BCI, which is the Bloomberg All Commodity Index, needs a long weekly candle for a long-term breakout from a multi-year long base. So I showed you above. What did I show you above? These all add together, all interconnected. We saw gold was breaking out against the S&P 500. And what's the Bloomberg All Commodity Strategy Index doing? It's breaking out of its base of a inverted shoulder head shoulder. So when I call it a confluence of information. It's a merging of information coming together to paint a picture for you as an investor. Then you add up these charts. Hey, look, Bloomberg Commodity Index is starting to break out, which means smart money is accumulating. Hey, look, gold's breaking out against the S&P 500. Hey, look, there's a 45-year cup and handle pattern breaking out on silver. Hey, look, copper is ready to break out and make potentially new highs over the next year. Add that all up together, guys. So then what is your next move as an investor? What hasn't broken out? What is cheap? What moves with the commodity index that is still cheap? Ding, ding, ding. Then when you find the sectors that are still cheap, you turn around and you look and you say, okay, what are the vehicles that I should play this with? How should I allocate to them? What's my investment strategy? I can help you with all that. That's what I'll say. And it's coming. Josh Young, I believe a big breakout in commodity is coming in commodities. And when it comes, we will look back on this chart and see that gold was shouting and screaming at us to take notice, as gold is running higher and the equal weighted commodity index has not followed yet. Gold's outperforming the S&P 500. Commodities follow. They follow. Coming down. Only a recession could break this correlation. Otherwise, like it or not, XOP, which is an oil and gas ETF, could very well go to the moon in 26, 27. Intermarket relationships matter, whether you think it's a coincidence or not. Look at how these are moving. And then we see a big move in the miners, and I think eventually XOP will follow. There's your opportunity. So what he's doing is he's comparing fractals of gold miners versus oil and gas. And we're very close here. We're getting very, very close. So gold's value is nothing but down relative to the United States money supply over the last 50 years, losing 11%. So this guy says, have fun staying poor in gold. And that was marked March 4th, 2024. That's called negative sentiment. This is what you're going to be buying when everyone else is telling you that. Have fun staying poor. I look at this chart. That's a falling wedge into a double bottom. That's exactly what I buy. This is a falling wedge into a double bottom. This guy's over here gloating in 2024 before it runs. Have fun staying poor. It's been down for 50 years. And you know what? This is the crazy thing. That's the exact reason I'm buying it. So for the most part, the reason that people give for not buying an asset is the same exact reason that I have for buying it. That's what's kind of ironic. They'll say, oh, it hasn't gone up for 50 years. And my reason is, well, yeah, it's down. It hasn't gone up for 50 years. That's why I'm buying the crap out of it. The downside is blowing out. It's taken out. That's when you make money. You make money when other people start making fun of you. that's when you make money. Katusa, when fertilizer spikes, your grocery bill follows. Right now, prices are still bouncing around, but the setup is building. Russia and Belarus still control potash. China has pulled back phosphate exports. Energy costs are swinging wildly. And farmers can only skip fertilizer for so long before yields collapse. Fertilizer price spikes precede U.S. food inflation, and it looks like it's heading back up. Another thing that I look at and that I am invested in is ammonium urea nitrate. There's the double bottom. Boom, breakout. Here's your retest. I'm just going to draw it like this. I know it's not very good, whatever. That's a double bottom there, boys. And we're starting to head higher. Food prices are probably going to go up, yes. Here's some other information. Back when I was watching the previous commodity bull market, there was an ammonium producer that I watched. I was not in it. I'm not stating I made any money in it. But I watched it. It did 100-bagger in it was probably about 4 or 5 years in the commodity bull market. 100 times your money. Then it got bought out later. I believe it was a nitrogen company. So I saw that, and yes, I have exposure to fertilizers, and I think there's a couple companies that could do something, maybe not 100 times, because it maybe be 100 times off the bottom in 2020, but we still have a lot of upside in some of these other ones. And here's another thing: ammonium is a fuel that could supplement or replace diesel in some areas, like shipping and stuff like that. And I think that's going to come. So I think there's multiple uses for some of these ideas. Silver 8 King. Silver has no reason to go down, but every reason to go up. Francis Hunt now forecasts $330 silver, calling this the best cup and handle setup of his entire career. Yes, we've been talking about this one a lot, the cup and handle. I show a lot of things on it. I don't know if it's going to go up or down in the short term, guys. What I would do is don't read this and say it has no reason to go down, but every reason to go up. The price is going to do what the price is going to do. Don't get any preconceived notions that it has to go higher, because when it goes down or it consolidates or whatever, it'll catch you off guard. So throw all the preconceived notions, throw it all out, and say, hey, it's a hell of a setup. I'm going to ride this thing through. That's kind of my viewpoint. And if we get a pullback, well, I'm not worried about it. I'm not surprised by it. It's something that you just have to endure. So don't get too bullish on things. That's where people, I think, have problems. They swing their emotions way too bullish, and then they go way too bearish. And then that there is the market swings. And that's where you have to, it's like you pull back when people get too bullish, and then you want to get really aggressive when people get too bearish in terms of buying. Coming down, this would be logical level for precious metals to take a breather. This is the equal weight precious metals index, gold futures, silver futures, platinum futures. And they're trying to use this extensions, the Fibonacci extensions, to get these type of areas where we could get consolidations or pullbacks. I'm not doing that. I'm just letting things go. So I'm not trying to predict anything. And a lot of people say, "Oh, well, we could get a pullback here," and then everybody gets in their head like this pullback is it's going to come. It's completely necessary. I don't know, so I remain open. I'll have an open mind. If we keep going higher, yeah, it's no problem. Some people use this as selling points. They sell out of the market and then they never get back in, and they're caught out of the market. That is the worst feeling that I have ever felt in my life. There were times where I was trying to trade things. I was a new investor, and we were breaking out like this, and then you get like a consolidation and you sell out, but it's not a very steep market correction, so you never buy back in, and then it rips again. Now you're screwed from a mental perspective. From a psychology perspective, it is so hard to sell something at a lower point and buy it back at a higher point. It is so hard to do that. And I am more afraid of missing the bull market, of losing my position, than I am of a correction or a pullback. So if we're in this bull market and we're seeing positive developments in, say, the gold to S&P 500 ratio, I am not going to sell my position. I am keeping my position on. That's where the big money's made. Mistakes are selling out, in my opinion. Natural gas is on the launch pad, says rock bottom entries. We've got a volume shelf launch pad below us, and it looks really good for a potential move higher, and I agree. What this is a double bottom breakout retest. That's what I see. So natural gas looks really good. Do you know what that also means? Coal looks good. If natural gas looks good, coal looks good. You know what else that means? Dry bulk looks good. And there's other sectors that look good. They are all interconnected. It says there's no privacy with any transaction utilizing digital garbage. There's nothing remotely decentralized about it either. The desperation to tell people to get out of gold and buy this worthless crap should set off major alarm bells with anyone who has a functioning brain. One day, people will come to realize who is really behind this. It's going to have a very ugly ending. As ever, be informed, not entertained. Do I not entertain you? What movie is that? Put that in the comments section. Do I not entertain you? Yeah, I don't know. I'm not I'm not negative on cryptocurrencies, but I'm definitely not positive. I don't want to be involved in it. That's where I come into play. I just don't want to be involved. Some people say, "Oh, just buy a little bit of everything." It's like, I don't see it. Tim Hack says I suspect the final peak of the market will be a maniac rotation into silver, heavy rare earths, and other geostratic metals and minerals. The emerging rift between East and West will be the catalyst. Yeah, I mean, that could be the case. Yeah, it could be the case. Definitely. Yeah, I agree to some degree. You know, this is really what it comes down to, guys. If you're going to invest money, you don't want to read these things and then make an opinion. Buy what's cheap. Buy the setups. Buy the opportunity. And then everyone else creates these narratives. Rare earths have bottomed. How many people were talking about the opportunity in rare earths at the bottom? Now that it's moved up, everyone is super bullish on it and they're talking about it. What you need to do is you buy the opportunity, the narratives come after. The articles, the press releases, they all come after the bottom. You can't use that. So what you need to do is you need to use your brain. You need to use technical analysis. You need to use ratios. You need to find the setups and get in there when no one's talking about it. Then you exercise your patience for it to play out. Then once it starts to play out, you start to read all these things. There will be a maniac rotation into silver. Well, there's a 45-year cup and handle. No crap. Heavy rare earths. Well, let's go look at rare earth metals. Well, crap, that's already bottomed. The buy point was down here. The articles and news comes out up here as a justification. They're using price as a justification to buy something. You know, there's another pattern that's exactly the same as this one that we're buying on the website. It's the exact same. I mean, it is literally the exact same setup. And we are right here. We are right there. It's the same damn setup. It's an individual company in one of the sectors that I follow. It's not rare earth. It's a different sector. But that's all I've got for today, guys. We'll end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Specialist coupon code. And that's all I've got. So we'll catch you next time, guys. See ya.